I appreciate y'all joining us today. I'm Ryan O'Shea. I'm one of the owners of Garda Insurance, and and we're an insurance agency, but we are. I think it's important to kind of define how that works. We're not State Farm. We are independent. We're brokers. We work for our clients. So that's just kind of how our kind of how our company works. So we work for all of y'all, not a big insurance company out there somewhere. Because there's a very big difference around that in kind of in the insurance world. So today we're going to talk about annuities, and we put the funny tagline on there on purpose. It's like, man, insurance is boring to a lot of people. It's super necessary, but man, it's something that people avoid often, and sometimes it's to our own detriment. And I'll just be honest, I have actually before even neglected to call my own insurance agent on like my auto insurance or something in the past, just because it's like, oh man, do I have to talk about insurance? So it's one of those subjects that's just kind of that way. So just so you know, that's annuities are what we're going to talk about today. And then the fun thing is we get to go through a legal disclosure about kind of how things work. And hey, um, if you don't love the legal disclosures, trust me, I dislike them even more. But it's this is um, this is how it works when Congress folks pass laws um, financial vehicles and all that, and half of them probably don't even know about said vehicles, but they pass laws because probably one bad apple decided to kind of steal some money from someone way back in the past, and then the whole world passes a law to just make sure it never happens again. I don't know. Thank you, Bernie Madoff, right? Um, so yeah, today we're really going to talk about annuities, and I'm just going to tell you we're not going to do the deepest dive because, man, I could teach annuities for like a whole 2-day course and all of you would be asleep and we would have to feed you nonstop coffee. So what we're going to do is kind of just go over it in a big, broad 10,000-foot view. And at the end, we are going to go through some numbers, but I don't want to bore you with those right up front. So let's talk about it from a conceptual level. So, and this is from an actual study. The reference is in there. It's small, so you might have to do a screenshot if you want to go look it up. But the idea here is consistency and predictability in retirement changes people's lives from a health perspective, from a predictability standpoint on, hey, am I going to be able to cover my mortgage? Or maybe you don't have a mortgage when you retire, but maybe your kids have something you're helping them out with, but like a very consistent and predictable number changes things. And then separately, what it changes is think about your money. If you know you're getting a certain amount of money coming in, then you can make different decisions with the rest of your money as far as, oh, hey, can I take some more risk over here? Can I take a vacation that I was thinking was going to be too expensive? Can I buy a second home or a condo or something? And oh, do I want another mortgage? It's like, well, if you have a number that's coming in no matter what, it helps you to make those decisions around, hey, let's let's do this. Let's make this great decision. And hey, that you might be married, you might not be married, you might be divorced, you might everyone's life is different. But man, that predictability has just statistically changed people's lives in kind of how they live financially in their later years. It has. Um, so so the bigger thing here is like, well, why the heck would I want an annuity, right? Like, Ryan, why would I want that? Um, and by the way, at the end of there's kind of a list here I'm going to go through, but the other thing is, why would I, like, what's the drawback? Why would I not? So trust me, I'm going to go through that too, because there is no financial product that's perfect. Otherwise, we would just do whatever that is, whatever that perfect thing is. So what an annuity can do for us, though, is the simple fact that it's predictable helps us kind of, you saw the prior slide around like the quote, just the predictability in of itself is great. And there's some variability within that. And we're going to go through that here in a minute, but it's predictable to a degree, and sometimes predictable all the way. It's also what in the investment world we call a non-correlated asset. And it's like, well, what the heck does that mean? It just means it doesn't do what other things are doing. It's like, oh, my real estate is down. Is my annuity down? Maybe, maybe not. Not if you're doing the kind we're talking about today, there is no down. But oh, hey, my crypto's down. Oh, hey, my stock portfolio went down. Oh, hey, whatever, pick a stock that you've kind of bet on in the future or down. That's why we call it a non-correlated asset. It's doing different things than your other financial assets are. And the other thing that I kind of love around this is the simple fact that annuities are basically financial vehicles sold by insurance companies. So rather than you going and buying it from, I mean, you could go buy it from your local credit union, but they're not financially backing it. Whoever works for them is probably selling you something from a giant insurance company. And we've seen kind of the turmoil that's happened in financial markets in the past. There's the 2008 thing. We can go all the way back to the dot-com crash. There's the early 80s in inflation, which we're kind of experiencing some of that right now, the higher interest rates. But for the most part, insurance companies just don't go out of business. And I will tell you, we've just seen enough of a timeline that some of these insurance companies have been around 150, 160 years and have just done what they do. And then also we put it on there, but every state's a little different. So if you have questions around this, contact us or contact kind of a trusted individual who knows kind of your state laws around this. But there are protections for insurance products, meaning in bankruptcy of the insurance company or you being sued or any of that. And it varies by state, what the limits are on that. But an annuity is nice that way. And then and it's I put set it and forget it sort of on purpose because you're going to see this later. We're going to talk about some indexing and things that way that can happen. But in a general sense, when you buy one, it's kind of it's a long-term solution in most cases, but sometimes it's a short-term solution if income is needed immediately. And then just in a general sense, people are like, well, what people end up with what I'd call money in jail. Oh, you're no longer your employer and you have an old 401k, or you contributed to it. I mean, especially if you've worked with us, maybe you've contributed to an IRA or a 401k or a simple or a SEP. I mean, there's a laundry list of these for maybe 20 years of your life. And then you decided you wanted cash value life insurance. And so you were doing that and overfunding the life insurance and all that, but you still have this other asset kind of just sitting over there idly, and maybe it's invested, but maybe it's not in alignment with what you're trying to do. So for me, that's like it's an easy solution. I'm going to share a personal story on this. So I worked for one of the largest brokerage firms in our country, and of course they encourage you to do 401ks and profit sharing and all that stuff. So most of your money and bonuses and such get paid into pre-tax vehicles, tax-deferred vehicles. So, well, what I did when I left there was I actually started investing money in a more immediate kind of nature, real estate, cash value insurance, all that sort of thing, where you pay tax and then you invest in these vehicles. And there's still a ton of tax advantages there, but you've paid income tax on those dollars. But then I had this bucket of cash that's all pre-tax. And at the time I was, 30 years old, I think, and just had this bucket of cash. And it's like, well, I'm not spending my retirement money for a whole lot of years at this point. Well, the annuities we're going to talk about today are exactly what I did with the bulk of that money is, hey, annuities are usually kind of a long-term investment. They're really predictable. I like predictability and consistency. I like the idea of a stability of an insurance company over a bank. And oh, hey, I have this money that I don't want to withdraw and pay a penalty plus tax and all that stuff on it immediately. Well, this was a great solution for that. Is just kind of, well, you can just move it over there, no harm, no foul. I had no tax consequences whatsoever. It was essentially just me moving money from my right hand to my left hand. So just so you understand one of the concepts that could work for someone out there, and it's something I've done for a whole lot of clients, but I actually did it myself. It's a I'm one of those people who thinks about it in finance. I'll do some experimental things sometimes in finance. Like I got into crypto super early and all that, but it's like if you work in finance, you should, to get a good education on all this stuff, you should try it. So I encourage the folks who work with me, I do it myself. And whenever I'm speaking to people in that, because sometimes I'll present to other financial advisors out there. And it's like, well, don't sell something to someone, or don't sell your idea to someone if you haven't tried it, or at least maybe you're super young, but it's something you can't do till you're older. It's like someone around you should have tried it, and you should have been able to see the proof so that you actually had some of your own money and or brain power kind of on the line to get it done before you start having other people do it. So so I do want to kind of go into just what's an annuity, which, sorry if some of you may know some of this, but we'll just kind of start at the beginning. And I kind of covered that these are sold by insurance companies, but the idea is just it being a financial product that insurance companies are out there selling. And what, like I said in the beginning, us as Garda, we work for you, not these insurance companies. So we can do business kind of anywhere we want. So we'll try and choose based upon your situation what's best for any given client in that, because everyone's different that way, you know. So they'll pay you out over time, or they'll pay you out starting immediately, or you defer it and then it pays you out later. There's a whole bunch of kind of different ways they can work, but at its root level, it is basically a financial vehicle coming from an insurance company. And it's, hey, do you need money starting tomorrow, or do you need money starting a decade from now, or something like that, you know, or 3 years from now, or 20 years from now. So that's what would kind of determine which type of annuity would be best for you. Is kind of, well, what's your need, and is it linked to a grander strategy, you know, around things. So I've had a lot of clients who will get an inheritance and will do some type of annuity, because maybe you're kind of young and you get an inheritance. Well, maybe number one choice is you buy a rental property, or maybe you buy an annuity, or maybe it's enough money that you do both. And you kind of remember that non-correlated asset thing. That's kind of why you do more than one strategy, you know. Just don't be that just don't be that person that has 25 financial strategies. I do this for a living, and that scares me to death when I have the clients that are doing so many different strategies. So essentially, the couple types of annuities that are out there, in if we're just going to stay at 10,000 feet, are the immediate kind and the deferred kind. Today we're going to talk about deferred, but just know we do both. And just remember what I said. I could teach this for 8 hours and then everyone would be asleep. So we gotta pick one to focus on. Today we're focusing on deferred annuities. Immediate annuities, just so we can cover it kind of quickly, just think of it this way. You're buying an income stream. You give someone $100,000, or some insurance company $100,000. You say, I want income for this number of years. And they just say, hey, okay, I'll pay you this. It's buying an income stream. Deferred annuities, the idea is that you put it in there, it grows, and then on the back end you get paid. And that back end could be as little as 13 months, or as long as until you have to start taking money in your 70s. So but that's the idea. Deferred is what we're going to cover today, on just that. This is how you grow it over time, and this is the type of income stream it could turn into for you. So that's kind of that'll be our main focus. And so we actually, and then another quote from some friends of ours, but it's actually very, very true. It is something that I kind of spoke about to begin. the call here, the presentation is the fact that you have certainty on your income actually helps you live a more abundant life. You're not operating out of the fear of scarcity or running out of money or that sort of thing. Instead, you're making decisions on, well, your can I afford this decision is very much influenced by not having to be in a place of stress about whether you're going to cover your bills every month, and I mean, a lot of people are, Social Security is a big part of kind of what they're planning on and everything, but um, think of it this way. Well, what if that wasn't there? Are you going to do something to create some certainty in your own life, separate separate from the government, separate from taxes you've paid and all that? It's something excellent for people's mental health, and it's pretty intuitive that it should be. And then when you have that kind of certainty in your life, maybe you sleep better, maybe you change your decisions, maybe you don't fight about money with your significant other. It could be as simple as that, where it just, yeah, maybe you're going to spend more, but maybe even if you don't spend more, maybe you're just in a better place, as far as kind of your mental health and that sort of thing, which, man, who doesn't want that, right? We're all living better lives when we're in a good place and can smile and be happy and have one less thing to stress about in life, because there are plenty of things that life throws at you. Well, what if that's not one of them? What if you've checked that off the list? So I'm going to go through kind of quickly, just kind of in deferred annuities, kind of the categories that are out there. So a fixed annuities, they're kind of the oldest one out there as far as how things go. Think of them as the whole life insurance of the annuity world. So the way a fixed annuity works, and people almost stopped buying them altogether. A financial vehicle that a lot of people are familiar with is like a CD from a bank. But remember, I like the insurance companies better in this aspect. So they pay similar rates of return, but it's not from a bank; it's from a life insurance company, which just have historically better consistency on not going out of business, on paying their bills. So 5 to 7%, but it depends, because on a fixed annuity, you're going to pick a time period, which you could buy one that's 6 months or 10 years. And so based on that, you're going to get the interest rate that you're tying your money up for. These were almost down to 0% for a while there, but with interest rates where they are, they've come back up to their historic norms for the most part. And they do serve a purpose that way, especially if you've got someone who really just, if you're someone who has a certain dollar amount that you need to be a certain dollar amount a few years in the future, it's a great way to do that, because it's predictable within pennies, of where it's going to end up. The illustrations we're going to look at, the spreadsheets we're going to look at here in a minute, are of the middle variety here, the indexed annuities. So index, the way it works is most all of them have a floor where you can't lose money, and you can't lose money based upon the indexes you're choosing, but some of them do have fees that could eat into your principal. So the idea is that your upside is based upon what you're choosing as far as your indices that you're participating in, and then your downside just has a floor as low as it can go. And for the most part, it's like not losing any money, but your worst case is you don't lose any money for a year, even if things are bad. So, and then variable are very popular. You can imagine which companies sell these. We're going to go through cost here in a moment. The variables, almost like having an annuity, and then inside of that annuity, your upside is based upon basically a bunch of mutual funds that you buy. And they don't call them mutual funds in there, but excuse me, but that's basically what they are. It's mutual funds determining your upside, but then you have the cost, which that's actually our next slide, which I don't participate, like I have the licenses to sell variable annuities, but I don't generally do that. And you'll kind of get it right here. So the fixed, Yeah, there's a cost, but the cost is not something that you need to necessarily worry about because it's baked into your rate of return. If they tell you you're going to make 5%, you're going to make 5%. And maybe there was a fee built in there, but your rate of return is net of the fees. So the fixed is just, hey, here's what this is going to do, almost to the penny, like I said. And if you don't like it, don't do it, because it's the rate of return is the rate of return. Now the index, um, they'll use a term, it's a life insurance and annuity term. You will hear the term rider. So when you hear the word rider, and I only say this in case you just all decide to do some of your own research, which I hope you do. Um, a rider basically just means feature. It's something you add to an insurance product. It's just an industry term called a rider. So the index and the variable work is, it's like, okay, well, what things did you add? And then they'll have a cost, So the indexed will have a cost to it typically. And yeah, usually 1 to 2%. But and I'll show you kind of how that works here in a minute so that you guys can wrap your head around real life kind of numbers. But there will be a cost, but then the guarantee is kind of to make sure you don't lose. So you might be down a little bit in 1 year because you made zero and their fee was 0.75% or something, but you end up making that up where you're not going to lose money. So a variable annuity, and most of them don't have all of these, and this is not an exhaustive list, by the way, but I just wanted everyone to be able to see the annuity has a very similar cost to the index annuity, that's just the kind of the administrative. I mean, they got to send you statements, they got to go invest your money and calculate all that, like there are employees out there doing things, to run your annuity. So that's why the cost is kind of in that. And you may have someone who wants to manage your money inside of that, like someone like myself, like an investment advisor or something, and they may charge you a fee for that, or they may get a commission for that, or they may get both, actually, which that makes it even scarier, I suppose. So there may be a fee charged to kind of manage your money, and there are low cost options in the variable annuity world. So this is going to sound like I'm saying they're all bad. They're not necessarily. I'm mostly just trying to get you out kind of a list of, hey, what could they charge me? And then your mutual funds, but they're not mutual funds, but those aren't free either because there's some investment manager running the fund that's investing in the S&P 500 or the tech sector or whatever you pick, right? So there's someone there. And then some of them, I call it a sales load on here, but just think commission. Some of them just have a fee to walk in or walk out the door, where it's basically just a commission, to someone. And like I said, usually not all of these are going to happen at once in a variable annuity. But just in case anyone out there owns them or your family owns them, I just want you to know there's like half a dozen different angles that there could be a cost, going on a variable annuity. So yeah, I just wanted to kind of go through kind of how those work and just kind of the categories, but then also, well, what's the cost and all that. And hey, if you want to know how it works out there in the world, because I ask this, it's go to a car dealership or something, you don't need to ask how they're getting paid, So someone like Guard Insurance or myself, you come by a fixed annuity or an indexed annuity, I'm going to get a commission, and that's how it works. Most of them just pay it up front, and then and as an agent, you just get kind of get your money that way, because it's like, well, where does all this cost go? The only one that would be different than that would be the variable annuity, just because you may have an advisor that kind of gets an ongoing fee, kind of like a money manager would. So anyway, these are yeah. see what we're like harping on here. Simply the fact that the peace of mind thing. So hopefully all that information wasn't too boring for you. but it's kind of necessary to go through the types of annuities. So we know what we're up against. And like I said, I could teach this for an 8-hour class, but just so you can kind of at a high level understand the types. But yeah, once again, just now you can see the different ways we could create certainty for you, right? Through a fix, through an index, a variable annuities also have riders that create guaranteed income. So all of them kind of fit that category. All three of them fit the category of a guaranteed income stream for you in the future. So specifically on the index side, we're going to cover an example here in a moment, but the reality is the annuity world's slightly complex, but when you boil it down into someone's needs, it's pretty easy to simplify it so that people can understand kind of what they're getting into. But just it's like talking about life insurance, right? It's like a very huge subject. So there are lots of avenues you could go. But yeah, today we're looking at growing money over time and then creating an income stream coming out the back end. And there are a few ways that these could work. And I'm gonna actually just show you this in a minute. So there are two different, well, I mean, there's a whole bunch of values in an annuity, but there are two that I would worry about kind of as the biggest things you're thinking about. One is, well, what's my accumulation value? And your accumulation value is hey, if I walk away tomorrow, how much money do I get? Like how much money do I have? And then there's an income value, which is designed to always be bigger than your accumulation value. And surprise, surprise, it's designed to be bigger because the insurance companies are trying to keep your money. It's they're in business just like any other business. They'd rather pay you an income stream over your lifetime than have to write you one big check. So they're kind of enticing you into that. So that's why I just put it in here kind of once again, so you can look it up if you want. But there are some annuities that will give you an upfront bonus on your income value, or maybe even an upfront bonus on your cash. I mean, you'd call it a teaser rate in the mortgage world, where they give you more money immediately. But then how much do I make each year going forward? And then a roll-up rate is a term, and I'm going to show you real ones here in a second, where, hey, my income value is guaranteed to grow by this amount every year. Or maybe it's hooked to an index, but it's hey, if I walk in the door with a certain amount of money, the market determines kind of my upside on that money, but the insurance company is willing to guarantee me a different number to grow my income value over time. So that they're two different numbers, kind of your income value and your accumulation value. And there's certain annuities where they'd be the same, but they're pretty rare and frankly probably not something you would buy, just to be honest. So and then on the back end, there's also income options like joint income options. Hey, what if it's me and my wife? What if I don't just want income for my life? I want it for both of us. Okay, well, there are ways to do that. Or hey, what if I don't need income for the rest of my life, but I need it for 10 years? Or what if I want my income to have the potential to go up over time based on inflation? These are all options, and not every annuity is perfect, which is why you gotta kind of sort through the weeds to decide kind of what you want and what's the best fit for you. So I'm going to dig into a couple specific examples here, and oh, by the way, if as questions come up here, just go ahead and throw them in the chat. Jim's hosting for us today, and we'll get to all of your questions when we're done here. You're just going to have to bear with me for a couple spreadsheets if you can. Spreadsheets are things that are fun in my world, and I love it. And some other people love them. Other people do not. But it's this, we'll call this one a necessary evil for some people, or something that other people would say, no, this is the steak. This is the meat and potatoes that I wanted. So everyone works differently that way. So I just ran a couple examples. And I'm not even going to put the companies out there right now because they change their rates monthly, weekly, etc., on kind of what they'll pay and how it'll work. But these are as fresh as, gosh, 2 days ago. So these are kind of where rates are now. So on this first example here, and we're doing $200,000 on both of these, kind of as when you come in the door. But just remember that, and I don't know if I covered this before, but there are annuities that allow you to add money over time versus a lump sum. But when we run these calculations, you got to pick something. So we're happy to run those for you too. This is kind of a hypothetical example of what Ryan did, basically, right? Where I've left my job, I have a chunk of cash, and I want to invest that in an annuity. So I picked $200,000 on a 50-year-old individual. But like I said, we can do these for pretty much anyone. And one thing to think about on this, and started taking a side here for a moment, but these annuities could also be like, why would I want it? These annuities could also be a fantastic fit if you're that person who can't get life insurance, or you've bought as much life insurance as you can, or maybe you don't have heirs, so you're not that interested in kind of the death benefit of like the overfunded life insurance kind of strategy. These could be an excellent fit for those type of people as well. Just because some of them just do this income type thing that we're looking at, but there are some that actually have, remember, I use the word riders, some of them that have riders that are actually called enhanced death benefit riders, where maybe you do get paid more than your cash if you happen to pass away early, behind before life expectancy and those such sorts of things. Which I've used that for quite a few clients that kind of struggle for the qualifying for the life insurance. So, all right, so now I'm gonna talk numbers here for a moment. So this particular annuity, remember I said some have bonuses and some do not. So we're walking in the door with $200,000, and then right under where it says guaranteed lifetime benefit, you'll just see the number that says income base, but right next to it you see roll up rate. So so the details matter on these, and that's where we would show this all to you and prove it all out, but the details do matter. So it's an 8.5% roll up rate, which, what does that mean? It just means my income base goes up by 8.5% a year. Now, that does not mean you just made 8.5% on your money, because remember, there's that accumulation value that's right over to the left of it, where it's going down. It's going down in this case, and it doesn't need to. There are different ways we could do this, but we were maximizing for income in this case. So you're paying for that rider. You're paying for that rider. And guess what? It doesn't necessarily go down every year because there is that index. So that number could technically go up. But we're talking income today. So the income is that that number where it's 260, 282, 306. It's going up 8.5% a year. So they want those two numbers, right, to entice you for them to keep your money. Because you get a number of years in here, and we're talking about 600 plus thousand, almost $700,000 in income base. Now, what does income base mean? It means that's how they're going to calculate your income. And once again, it does not mean you have almost $700,000. They're going to take that $692,000, multiply it by your benefit rate, which is only one right there. It's the 5.03, and this is right now. And most annuities, that they'll pay you a bigger percentage of that number the longer you wait to take your income. So in this case, it's a little over 5% of your 692,000. So we come out with a little under 35,000 a year in income. So the way for you to think of it this way is, I just spent $200,000 to buy myself $35,000 in income. And it might be more, but it's actually not going to be less than that in this case, because of kind of the guarantees they provide and all that. So you're basically buying an income stream, and it's and Are there other things you could do? Yeah, maybe you own a rental property and it'll produce better for you. You also might get a call that the toilet's broken in the middle of the night. These guys, it's mailbox money. The money just shows up. Remember that whole consistency and predictability thing. So, and I also ran just a second example, just to get you guys an idea on how these work. I don't want to bore you by spending half of our time here talking about spreadsheets. But this is a different company. And remember how I said the devil's in the details? You walk in with $200,000 at this company also. And you'll see their roll-up rate is 6.5% as opposed to 8.5%. But remember the devil being in the details? Look at their benefit rate, their payout rate. It's north of 6%. So you walked in with the same dollar amount, and one company is enticing you with an 8.5% roll-up rate, while the other one has a 6.5% roll-up rate, but they pay out better coming out the back end. So you end up a couple $1,000s a year ahead with this example. So just wanted to give you a couple, because we're pretty agnostic as far as insurance companies, mostly just trying to do what's best for you. So yeah, it's remember the whole non-correlated asset thing. So we do this so that you can get the peace of mind on a certain level of income. And I know $37,000 a year doesn't move the needle for everyone, but it's like, well, what could that cover for you? Sounds like a couple pretty awesome vacations a year, or whatever. Or some people will use it to pay the mortgage on the condo that they bought, or something like that. So it's just more about kind of having that predictability, and an asset that does something different than what your other assets are doing. And just remember back when we were talking about the beginning here, like long-term money is an easy fit for this, but there are also ways to do this same sort of strategy if you're not the person that has a bunch of money, to just start one immediately with a giant chunk of cash. We can still add cash to these over time. It just might be a different company than one or the other, but that's kind of our job, is to chase those sorts of things and make sure we're getting you in the best spot you can. And so just remember the whole predictability thing, and then the fact that the devil's in the details on these annuities. They really are. Which that's why they put the spreadsheets down, even though they're spreadsheets, is to make sure you understand kind of how all of it works. So yeah, that's kind of what I wanted to cover for the most part today. But make sure to hop into the chat if there's questions you guys have, and we can go through that. But just remember kind of how they work and the types. And then if you have questions about, hey, could this work for me? Could this not work for me? Well, we just give us a call or reach out to us. We're happy to hop on and just do one-on-one consultations on this, because it can also be uncomfortable for folks to ask questions in a chat in this sort of environment when it's for the whole world to hear your question. Just know that I'm a fiduciary. So if you need to call me and ask questions around some of this, then please do. And it's not going to leave my knowledge, but then it helps us help you in a better way, just understanding your particular situation. So yeah. We're probably just going to kind of hop to Q&A here in a moment. But yeah, this is something that matters. And I threw the last one on here on purpose, just in case it confused someone when I said your accumulation value is going down over time, but they're paying you. So it's like, yeah, it's a depreciating asset, quote unquote, that continues to pay you an exact amount or a predictable amount, or maybe even an increasing amount that's hooked to inflation in some way, shape, or form, depending on the company And depending on which rider, which feature slash rider slash benefit you choose to go with your annuity. So excellent. So I appreciate everyone hopping on today.